Welcome to Real Estate Investing Abundance, the show for busy, fulfilled professionals like you to learn how to develop financial independence built on solid, passive real estate investments. Now, here is your host, Dr. Alan Lomax.
Hello, enlightened investors. Welcome back to Real Estate Investing Abundance. I'm your host, Dr. Alan, and I surely appreciate you being back with us again today. And we are going to have a very informative show today, as we're going to talk about tax strategies that our CPA probably doesn't mention to us. With us today is Jason Mandel, and he has over 25 years of entrepreneurial experience in financial services and risk management. Jason is founder of the Mandel Family Office and was a principal at SkyGem Advisors, a business consulting firm. And previously, he was a partner at Soundview Strategic Advisors and HM Fund Management. Jason has also held positions at the LaFrac organization, D.E. Shaw, and Cantor Fitzgerald. So welcome to the show, Jason, and take us into the show and share a memorable experience that helped you to be who you are today.
First off, I want to thank you, Alan, for inviting me. It's a real pleasure to be here and share some insight and have a great conversation with you. So I do very much appreciate this opportunity. Well, I'll tell you a little bit, Alan, of a memory of something that really affected me tremendously. I had the pleasure of working for a very fascinating man named Sam Lefrak. And Sam was the son of the founder of the LeFrak organization, an immigrant to our country in the early 1900s, who built one of the most amazing multifamily real estate portfolios in our country. Sam, as a first-generation American, continued to build on the success of his father. Sam's son, Richard, today, still managing the family business. And Sam's grandsons involved heavily in the business, Jamie and Harry. When I worked for Sam prior to his death in the 1990s, I had a chance to talk to him almost every day. We talked about his investment portfolio. We had a chat about his portfolio. He was curious, and my experience on Wall Street at several large firms prior to joining his family office gave me an amazing insight that was intriguing to him. But I have to tell you, I got so much more out of the conversations than you could ever imagine. As much as I shared details on his investment portfolio and alternative investment managers, and again, I did things outside of the real estate world for him and for his family, the conversations, the insight is something I'll never forget. And it taught me so much. And so much of what I do today to help real estate investors mitigate their taxes are strategies that I learned observing and being part of the Lefrak family. So that's something that I'll always cherish, the time that I had to speak to somebody who had built an incredible portfolio, but had done it with such grace and success and keeping to a strong moral compass. I really was blessed to have that experience. Very, very few people have that chance to spend time every day with somebody towards the end of his career who was able to share with me such insight and perspective. So I was blessed. And then in 1999, I left working for him and I started my own company. And I've been on my own since. And they were gracious supporters. Even today, we've offered some interesting renters insurance solutions for all their tenants in their multifamily. So it was a way of reducing taxes on their property by showing tenants to have renters insurance. So the common areas, of course, would still need to be protected, but the actual apartments themselves were protected from the tenants. And that's a growing trend amongst real estate owners who are now mandating that their tenants have renters insurance. It was never something that was mandated before. I've been actively involved over the past 10 to 15 years, really focused on helping real estate owners utilize renters insurance as a tool to reduce their taxable their costs for their property and casualty exposure.
Well, mentors are a wonderful thing to have, but as you mentioned, it was a unique experience for you and really an unusual experience. Most of us do not have that close a contact with our mentors, and certainly it's challenging to find mentors of that caliber. So you were indeed very fortunate. Enlightened investors, if you haven't done so already, be sure and click that like button and also click that share so others can take advantage of the content. And finally, be sure to subscribe so you don't miss a single one of our upcoming episodes. Well, let's go right into this, Jason, and tell us, what are some of the primary tax saving strategies that real estate investors in particular should be aware of?
Yes, well, a lot of real estate investors and a bulk of my clients here at the Mandel family office are in the real estate industry or have significant exposure to commercial real estate, multifamily, variety of different real estate investments. And a lot of the commonality that we see right now is obviously investors seeing cap rates come down. They see higher scrutiny on strategies they may have used in the past, like cost segregation. There's a general fear now that some of the programs that were made available to real estate owners are potentially going to be reviewed heavily by the IRS. We're obviously concerned. We look back to the captive insurance markets that a lot of real estate owners started to utilize strategies to build their own little tiny insurance companies and then take the deduction. If there weren't claims that were made, they were able to pass through the success of the insurance company to their heirs in a tax advantaged way. So we look at these things that later on the IRS got very aggressive about, and potentially, again, with cost segregation, we may be seeing a very similar environment that we saw with captives, where the IRS is aggressively trying to pursue to confirm that people that did cost segregation programs did it compliantly. It brings me back to a lesson, again, back to what Sam Lefrak shared with me, that he asked me at one point, why don't you look at some tax mitigation strategies that could be compelling? And I did that. And I was kind of curious when he asked me to do that, Alan, because I'm actually not a CPA and I'm not a tax attorney. So I was curious, why would he ask somebody with a broad Wall Street experience to look at these? And he shared with me, he thought I was creative and he thought that I might be able to evaluate strategies as an entrepreneur. And that's sort of what I built my career on since I started my multifamily office in 1999, is to identify strategies that are out there. But one thing that I'm very focused on, Alan, is not participating in tax shelters. And what I define as a shelter is something that is an interpretation of tax law. So a very smart attorney would read the law, a CPA may work with that attorney, and they come up with a brilliant idea. And that idea is to do something outside of necessarily what they're reading in the law, but maybe it draws an analogy, it gives them an insight, and they believe that the idea they bring to the table is compliant if you manipulate it a certain way, if you do certain things. These, I call these tax shelters. These are interpretations. Alan, I have found over time that the IRS has a different interpretation over time when more people have a view. And I don't personally participate in tax shelters. Again, I'm not judging anybody that does. I will simply say that in my belief, Alan, there's a multitude of strategies that exist, black and white, in the tax code, where you do not need to interpret tax law. You don't need a lawyer to charge you $100,000 for a tax opinion to tell you it's okay to manipulate the law in a certain way and protect yourself. Frankly, why most people buy these opinions from big fancy law firms is because they want to cover themselves in the event that the IRS does attack the structure. They want to say, I depended on my lawyer. I depended on my CPA. I'm not a bad guy. I just followed the advice of my counsel. And when you do that, historically, many times the end user, consumer, can avoid going to jail or having, there's normally penalties, but maybe they might be a little more sensitive to the penalties if you went out and got that opinion. Now, the people that are promoting these, and they actually call them promoters of these types of strategies, run the risk of actually going to jail and run the risk of significant financial penalties. So I decided a long time ago, probably it was 2000 or so, I said, you know what, these fancy people coming to me, showing me these crazy strategies that are brilliant, but they are, again, interpretations. And the IRS may have a different interpretation. So a key message for your listeners is that the strategies that I believe make sense and are consistent are ones that we can find directly in the tax code. So let me address some of the simplest ones that I believe exist, that I think most accountants and most lawyers do not know about. And it's been the bane of my existence for many, many years, because I have to tell you now, after all these years, and I've been doing this since 1999, more people are familiar with this, Alan. That's a good news. I'll tell a quick story about a very large firm who provided analysis. I probably shouldn't say their name, but it's one of the Wall Street's top investment banks, well regarded by everybody. And one of my clients, very, very wealthy, also a billionaire, decided to ask them their opinion on this strategy. And I will now talk about the strategy, but I'll just tell you that their assessment was that the strategy was legal. The strategy was in the tax code, as I told you, I demand, but they weren't comfortable with it. It was new to them. And they said, we think the IRS will do away with this, even though it was in the tax code. And the funny part is this particular firm was never a fan of some of my ideas. But as of last year, they have now said that this strategy is the greatest strategy available to real estate investors and wealthy individuals. So let me jump right into it, Alan, and tell you what this strategy is, because I think it's going to amaze you and I think it's going to surprise you, because this strategy is so plain vanilla, yet underutilized. The strategy is based on the concept that life insurance has many different forms. The form that most of us know is term insurance. God forbid you're hurt, your family would receive, or if you died, your family would receive an amount of money to make up years of lost income. Most people, this is called term insurance. It's very cheap because the term is likely to be much shorter than your life expectancy. So if you buy a 30-year life insurance policy as a 30-year-old, chances are you will live past 60, statistically. Now, of course, God forbid, people do die, accidents, disease, it happens, but it's a very, very small segment of the population. Insurance companies make a fortune on the idea that people pay for 30 years and then cannot afford the payment in year 31 when the price jumps up to an exorbitant level. And they lapse the policy, or the policy has fulfilled its purpose, which was income replacement. Now they're approaching retirement. Hopefully they've saved money, and this is a wonderful product that every family should own to protect the loss of income in the event of a low probability event, which would be a mortality. That's what most people use insurance for in this country. It's cheap, it's wonderful, it provides safety, and every person should protect their children and their spouse. If you're the breadwinner in your family, it's an important tool. It's give up going to dinner once or twice during the year and protect your family, is my belief. The other type of insurance is cash value, permanent life insurance. And these are policies that are considered whole life insurance. These are policies from well-known companies like Mass Mutual, Guardian, New York Life. These are well-regarded companies that have existed for hundreds of years, and they provided people a dividend every year on their money. So instead of just paying for the cost of term insurance that you'll never likely use, you actually put extra money in. The premiums are much more money. But what you're getting above that cost of the insurance is a fixed savings amount. And in whole life, it's a dividend, could be 5 or 6%. And a lot of people really benefit from this product because it's a form of forced savings. It's a wonderful solution, helps people pay for college for their kids, retirement income, because as that money grows, if you had your money in a bank CD, you're being taxed on the interest that you receive. Inside of this policy, you receive no taxation. It grows tax-free. So we all are positioned this. A lot of marketing people and salespeople try to sell us this, and most people have been presented this opportunity, and some people purchase it. The other type of permanent insurance that's common is something called indexed universal life, and it's the exposure to insurance that gives you the exposure to a stock market index like the S&P 500. And the S&P 500, of course, is a very well-regarded way of taking calculated risk in the sense that the S&P is volatile. There are years the market's down, years the market's up. The market's net down over 2 years, but we had 20% plus swings up and down. So it was very volatile. So some people like indexed universal life because you have exposure to the index, but it cannot go down in value. It's a very interesting tool to get market exposure on the upside with no downside. And we show people, we show them the Japanese stock market over the past 30 years. It hasn't done very well. People that invested in that market expecting great returns over 30 years to build money for retirement have been incredibly decimated in the sense that the market's volatility up and down, they're basically flat, Alan. They didn't make any money. How do you retire with no growth over 30 years? We know that's why many of us invest in real estate, because of the opportunity. So I feel badly for those people. So one way of exposure to have the upside but no downside is actually through life insurance. Indexed universal life gives us exposure to the stock market. There are some products that have uncapped exposure, some products that have a cap exposure. These are a key part of an investment portfolio. Most people don't have any idea this is relevant or something they should consider. Most big asset management firms don't offer this solution because there's really not the same fees that many firms manage stocks or bonds. They charge a fee every year. This is not one of those products. There's a fee normally in the first year. Sometimes there's a fee spread out over a few years, but it's much smaller than what you might be able to make managing money, buying stocks and bonds. Now, Alan, I'm telling you all of this because I want you to understand the fourth type of insurance, and that's something called variable universal life. And this one is different. This one you could lose money on, but this one allows you to hire a money manager who will place investments inside of your life insurance policy. Why would we want investments inside of a life insurance policy? The answer is simple. As I told you, life insurance policy cash value grows tax-free. So imagine for a moment that you had a multifamily property owned by your life insurance, not owned by you, not owned by your trust, not owned by your LLC, because all of those entities are taxable. They create income for us every year on the rent roll. If we sell a property, we have a gain. Now, of course, we have our 1031s, but what if we're not happy with the cap rates? What if we want to exit an investment, not feel forced to buy another real estate investment? Alan, this vehicle, in a variable universal life, and in the construct that we have developed it, and I've been very involved in this industry since the 1990s, the product today allows from certain carriers the ability to place assets like real estate inside of a policy. Now, this is something that blows people's minds. They say, what do you mean? How can I put a building? I want to buy this building. It's a brand, down the road. It's a great multifamily. I want to own it. I'm just going to set up an LLC and buy it. Or I have a trust so I can eliminate the estate tax and my children can inherit this building. That's great. But that rent roll that comes in every year, it's taxable. And if you sold it for some reason, you pay gains if you made money. Alan, I implore your listeners to consider the idea of wrapping their real estate inside of life insurance. My firm specializes in this. And if they want to, we are happy to have a no-fee consultation to give them details on how this could fit within their portfolio. Because you can imagine, Alan, if we were all making our 12% IRRs, that would be great, but we're not. And when we redeploy money into new multifamilies, some of us are receiving 2, 3, 4% IRRs in cap rates. Well, Alan, if that gross return was our net return, that's more compelling. And, and I really believe many CPAs do not know that their clients who own real estate can structure that real estate inside of life insurance. Now, there's no doubt, Alan, there's a whole bunch of restrictions. I want to be clear. There's no free lunch in the world. The way that this works is the investor can no longer have complete control. So if they go out and buy a multifamily, they have to actually invest with a manager, with the real estate professional. And that person is managing the LLC, and the investor in that LLC or in that vehicle, which owns the property, is not the client individually. It's not their LLC, their own LLC. When there's a 1099 or a K1 issued, the owner of the asset is a life insurance company. It's policy number 1248 on the life of Jason Mandel, issued by insurance company XYZ. That's what someone has to be comfortable with. And you've got to appoint somebody to manage that cash value. And you need diversification inside, Alan. This is not good enough to just say, I'm going to put this one building in. The IRS is very, very focused on making sure this is compliant as life insurance. Somebody wants to play a game and control a building and do this, they're going to get caught. They're going to go to jail possibly, and they're definitely going to get the policy contested. It's not worth playing a game. There's too much wonderful tax benefits here, Alan, that if somebody is a real estate investor and they want to eliminate taxation on all of their investments in addition to real estate. But I believe real estate is particularly well suited. You have so many benefits of wrapping it inside. You have asset protection from creditors. Imagine a crazy scenario where someone slips and falls and somehow the insurance wasn't in place and there's a judgment against you. God forbid you own a building and that happens. Well, owning that building through the policy offers tremendous asset protection benefits without exorbitant fees for insurance and other types of mitigation strategies. I implore people, I know real estate owners that have been destroyed by litigation. When someone finds out that an insurance company is the owner of the building, they know they have deep pockets and they're not going to likely sue and they're not going to try to shake somebody down. So I think owning real estate inside of a life insurance policy is an absolutely underutilized strategy. It's a strategy that if you sit down with your CPA and you say, why can't I own it inside of my life insurance? Chances are the response will be, I've never heard of this before. And any CPAs listening, I am happy to educate you without your client in the room if you're embarrassed that you don't know this and you think you should. I will spend the time necessary to teach you how this is done compliantly. And when we do this compliantly, we will be able to eliminate all taxation. 1099 income even can be dealt with. We have structures. We have W-2 mitigation strategies. We have cap gains, ordinary income, and of course, estate taxes. All of this can be dealt with our strategies. And I personally believe there are unfortunately many advisors. I'm not saying these people are not smart, Alan. These are talented attorneys. These are talented accountants. These are talented insurance brokers. These are talented asset managers. But unfortunately, they were never exposed to this. I was lucky to be exposed to this working for the Lefrak family. I was lucky that I made this a key part of my life. I was involved in this in a very granular way. But I really believe that any professional advisor owes it to their clients to research this area because this is no longer cutting edge. There are conferences on this strategy. There are many lawyers and accountants that pursue this strategy. The one big difference that I've noticed, Alan, and I do want to highlight this, insurance brokers, when you do PPLI, that's the name of this, private placement life insurance, a form of variable universal life, a very common form of insurance. But what happens is the brokers see a payday, Alan. They see a massive amount of money made on the sale of life insurance. And I have noticed, I've talked to many people who said, Jason, I know PPLI. I looked at it. It doesn't work. The brokers want such egregious fees for the sale of the life insurance that must be inside the insurance policy. You can't have a PPLI policy without life insurance death benefit. Otherwise, it's just an LLC or a policy. It needs death benefit. So the issue is when there's a massive fee that's being charged, and again, this fee can be as high as the entire first year premium. On these cases, we may have $1 million premium. There's a broker that's making a fortune. You can retire on that money. Now, here's the problem. When you do that and you charge the client this egregious fee, and I've actually received death benefits, Alan, because brokers hate that I talk about this. Hope I don't get more death benefits, frankly, from this. But, I got to tell you, I say to these people, look, the client, if you don't charge that egregious fee, the client doesn't need to post collateral. If we equate this to real estate, your listeners are used to putting down 20 or 30% with a bank. That's what they put down to buy a property. In this situation, the banks will give us 100% of the money needed to buy the insurance inside of this wrapper. Why? When you don't charge the egregious commissions, when you choose to put the client first, which is what my firm does, we have a more holistic view on this relationship with the client. When we do that, the policy death benefit, when you finance it with a bank, doesn't need a lot or sometimes any additional collateral, meaning the cash value inside of the life insurance surrenders for an amount equal or close to the amount been borrowed from the bank. So when the bank comes to me and I handle all the financing, that's part of my job function. When I do this and the bank says, Jason, where is Mr. Smith going to post his collateral? Is he giving us CDs? Is he giving us stocks and bonds? I say, no. I'll make it even better. I'll show you a AA credit. They're surrendering a policy from, let's say, Lincoln Financial using their enhanced cash value rider. that product surrenders for 100% of the premium put into it. So a good bank looks at that and says, we are so comfortable. We've got a contract. We can get all of our money back if something ever happened. That's an exciting solution, Alan, that I don't believe your listeners will ever have offered to them, because insurance brokers need to make a living, and I don't fault them for that. But as you know, my firm is a multifamily office. We have a holistic view to these relationships. Our website is themandelfamilyoffice.com. TheMandel family office. On that site, I describe what I do. I go through videos on my LinkedIn. If you look me up, Jason Mandel, on my YouTube channel, we talk about these strategies. Alan, we are helping our clients with their legal structures. We're helping them with their accounting work. We do an accounting what if, because we recommend and say, look, your accountant is not taking all the deductions you're entitled to. And you know what? If they want to listen to that, great. If they want to tear up our report, they can do that too. We also help them with any of their risk management, with their insurance solutions. We have an in-house insurance agency. And when it comes to asset management, most of my clients are doing some really innovative things right now, really fascinating things in the insurance world. I have a client right now doing some extraordinary work, and they showed it to us. They said, would you guys be our land bank? We're buying up land at $1,800 an acre. We're improving that land. We're putting in septic. We're putting in power. We're doing some great things. And clients want the ability to build their home and their choice. They have flexibility in this jurisdiction. It's in Tennessee, this particular transaction. So we're seeing some exciting ones. And when people buy that land, frankly, they're paying $10,000 an acre. So within 12 months, that type of extraordinary return with this innovation and these relationships, it is available. There are compelling real estate opportunities, Alan. You know that. You hear that. I've listened to your other people on your podcast. So what I do is I try to make that, enhance that. I try to make it more robust. And if I can eliminate taxation, well, that makes it a lot more exciting to make these types of investments. So I hope I've given you a little view as to my sense of what I do to help real estate investors mitigate taxations, to enhance their overall performance, and really to reduce their risk. That's a key part. That asset protection component of what we do is an underviewed part of the equation. People are excited to make their return, but they're exposed to real risks, and we mitigate those risks. If you're in business with someone in a partnership, imagine, God forbid, something happened to that person, call it an injury or possibly death. Well, all of a sudden, irrelevant of what the economic environment is, their estate may want liquidity. And if it's not the right time to refinance out any equity you have in a building, well, you're stuck. You're going to have to sell it. You may even take a loss. Alan, there are strategies that we employ for our real estate clients that mitigate that risk. These are simple buy-sell arrangements. But what we like to do is make it a little sexier by creating tax-free income, in addition, as a hedge on the performance inside of this business. So you show me a guy who's got a great real estate idea, super. Now let's mitigate that. Let's mitigate the risk of mortality risk, of disability risk. Let's mitigate litigation risk. Let's asset protect this. There's so much that could be done. And I know we're just kind of scratching the surface today, but I really appreciate the opportunity to share these views with your listeners, Alan. I give you a lot of credit because most people don't think of these ideas. And I know you wanted your listeners to hear about it. So I really thank you for the time and being able to share these ideas. And I hope they can find me on LinkedIn, Jason Mandel, the Mandel Family Office. They can find me on YouTube. They can find me on the internet. And, I do a lot of writing. I just came out with a book. It actually hit the #1 bestseller on Amazon in life insurance. It hit it for portfolio management. And I'm just thrilled. I'm thrilled that I could share these ideas with people. It's called Demand Transparency right there. And I invite people to take a look at it. And if they don't like it, I'll give them their money back, Alan. That's how confident I am. They'll get some good ideas in that book.
Well, Jason, it has been a very enlightening conversation, and we have come to the end of the program. Viewers and listeners, like Jason said, you can go to his website. There is educational material there. You can go to his YouTube site, and more educational material can be found there. And finally, Jason is offering you a free consultation. So take advantage of these things. and enlightened investors, thank you so much for being with us once again today. I look forward to being with you in our next episode.
Thank you, Alan. Really appreciate your time.
Enlightened investors, wait, don't go just yet. I just want to remind you about our recently launched webinar that you will not want to miss. If you're at all curious and would like to learn more about how real estate investing can diversify your investment portfolio, alleviate the anxiety associated with Wall Street swings, leverage your 401ks and IRAs to substantially increase the return on your investment, and do all of this with turnkey, hands-off, passive real estate investments, then you'll want to immediately go to steedtalker.com/webinar. In the webinar, we'll also address the common dubious investment schemes that you want to avoid. To access the webinar, go to steedtalker.com/webinar. I look forward to seeing you in the webinar.
Thank you for tuning in to Real Estate Investing Abundance, brought to you by Steed Talker Capital, a company working for passionate professionals like you to develop financial independence built on solid, passive real estate investments. As part of our efforts to make the world a better place, Steed Talker Capital contributes to activities and organizations committed to better understand the equine. These endeavors attempt to enhance the human treatment of horses worldwide. Steed Talker Capital, working for a world where all creatures, great and small, flourish abundantly. For resources to develop your financial independence, connect with us at steedtalker.com.